So lucky last, Dean Fergie from Cyan Investment Management. He's brought 3 stocks, and I like this, for a recession-proof portfolio. I began by asking Dean where in a company's growth cycle Cyan typically invests.
We're kind of looking for the stocks that aren't mainstream. So I think everyone can go and invest in a BHP or a CBA or these big stocks that everyone's heard of. We're looking for stocks that are large enough such that they're kind of commercially proven and somewhat being de-risked, but ones that haven't really been heard of, and so we don't think that the valuations are factored in there. And I think what you want to do is stocks go up because a stock finds new buyers. So if you can kind of be ahead of the curve and discovering stocks that are smaller and not as well discovered, then that's sort of where we try and operate in, and that's what we do. And so normally that sort of stocks cap between probably 30 to 50 mil up to kind of 250 is where we like to start. And if we can find good ones that grow above that, then that's great for us and great for our investors.
So Dean, I mean, does it bother you if these companies are not widely covered by broker research and the like?
Oh, no, not at all. Like, it's the exact opposite. Like, we think in a lot of cases, broker research is really conflicted. You kind of, it's historically been the case that 80 or 90% of broker coverage is a hold or a buy, and very few are a sell. So we don't really feel that's very important. And if something's covered, it means everyone knows about it, and there's no new information to find out. So if there's a lack of broker coverage, if we can go out and find newer businesses to the exchange or ones that have just been flying under the radar, then we think that's a really, really good place to look. And if we can kind of promote them and then they find a wider audience, then that's normally good for the share price as well.
All right, so let's talk some of these stocks. And I think the theme that you picked kind of took me by surprise, to be honest, Dean, because we're talking about the smaller end of the market, because we're talking about emerging companies, and you've picked 3 stocks for a recession-proof portfolio. So what's your thinking behind this?
Yeah, look, I realise the theme's a little bit contrary, but I think there's this arguably a misconception that the small end of the market's really, really risky, that these stocks are incredibly volatile, that you're taking a lot of operational and stock market risk by investing in them. And I guess what I want to show today is that stocks, in some respects are not cyclical at all, and I've got one in there that I think is counter-cyclical, and I think it's also topical. We're seeing the RBA, reducing rates, which is a sign of an economy that's struggling. I think consumer confidence is down. So I think if you can look at the smaller end at stocks that are maybe underappreciated, that have got really kind of defensive underlying fundamentals, I think they're stocks that should perform really well over the next couple of years. So it's contrary, but I think it's probably worth a listen.
Well, then let's get to it, shall we? And I'll just say that the first stock on your list is Alcidion. So this is a provider of, I suppose, software to the medical industry, hospitals and the like. So it's in the Australian market, clearly, and also making some inroads into the UK. So philosophically, how does this align with the Cyan investment thesis?
Yeah, well, I mean, I think firstly, like healthcare can be regarded as being, very counter-cyclical. That is not a business that is any related to how much people are spending or anything like that. Like, it's very stable. It's really topical today. We've seen a private hospital operator, Healthscope, go into administration. So I think that trying to make the hospital system more efficient and just having better patient outcomes is very important and will always be on topic. Alcidion is capped at about $140 million, so it's not well understood. And they are making really, really strong inroads into the hospital sectors, both in Australia and the UK. They're providing what they call clinical decision-making software. So hospitals are just overrun with data, be it where nurses are operating cardiology results, pathology results, radiology results, note-taking, medical coding. it is a minefield of data, and Alcidion provides software to make that data be inputted really easily, to predictively see which patients are at risk, to improve hospital efficiency in terms of bedding and patients in waiting rooms, and even how many ambulances are on the way in. And through that, they're seeing remarkable increases in efficiency in how the hospitals run. And in the last year, Alcidion won, I think, like $63 million of total contract value over the next sort of few years. So it's a business that's on the cusp of being really quite profitable at a very modest market cap, completely uncyclical, with $10 million in net cash. We think it's a business that people should look really carefully at in, because this could be substantially more valuable business in the next few years.
Yeah. Well, I think the most recent quarterly as well, they upgraded guidance. But one criticism that I've heard repeated about this company over the past few years is that, these contract wins, the revenue can be quite lumpy. So as a company like this matures, is that one metric that you're looking to see, even out, balance out?
Yeah, look, I think that's one that investors probably struggle with a bit. And any of these smaller businesses, I think investors can get really excited about them for a time, and then they lose interest. So there's certainly volatility in the share price. About 4 or 5 years ago, Alcidion won a really big contract with the Department of Defence to basically make all defence personnel's medical records electronic. That was a kind of a $10 million a year contract that rolled off last year. Thankfully, that's been replaced with a equally large contract at a hospital network called Northumbria in the UK. And so the lumpiness is an issue, but we're also seeing them winning lots of little kind of $1, $2 million a year contracts, which are all sort of for 3 or 4 years, if not longer. So I think what we're seeing is the business kind of maturing and not being, like a 1 or a 2 trick pony. And as we're seeing them winning more contracts both in Australia and overseas, I think it goes to the fact that the business is a lot more defensive, has got a lot more merit. There's more reference sites. So I think it's not being overly optimistic in seeing this business win a lot more contracts in the near future.
Final question on Alcidion. Kate Quirke has been the long-term CEO and managing director, I think going on 7 years. She's, from what I have seen, one of the largest individual shareholders in the company as well. Is she planning on staying, or does that factor into your decision-making process around stocks?
Look, you always want to see the people running the business with a reasonable holding. There are a couple of other shareholders in there. Malcolm Pridham's one, and there's one other whose name I can't recall off the top of my head, who are the two largest. You've then got Australian Super in there as the largest shareholder with about 10%. I think Kate, from memory, owns about 3 or 4%. So she's not a major shareholder. We're not talking a kind of a Richard White WiseTech kind of overbearing shareholding. Look, I mean, Kate's had some challenges. We've seen the stock go from 4 cents to 40 cents, back to 4, now up to 8. So it's been a really, really wild ride. I would say if it does go sideways or south, the chair and Rebecca Wilson might be looking at time to make a replacement. But at the moment, like as you said, the company's just upgraded their earnings, upgraded their guidance. They're going to be cash flow and EBITDA positive for the first financial year in their lifetime. So I think there are enough runs on the board there that investors will back Kate for the foreseeable future, myself included.
Got it. So Acusensus is the next on the list. The ticker code for this one, we'll put it at the bottom of the screen, is ACE. So again, a company that is based on these contract wins, which I presume you want to see, Dean, lead to this recurring revenue, that sort of holy grail when it comes to some of these smaller companies.
Yeah, that's right. So Acusensus has been listed for about 2 or 3 years. So it's a pretty new business to the exchange. They make smart traffic cameras that basically look at, monitor speed, but more importantly, they monitor distracted driving. So mobile phones and also seatbelt compliance. So They're a lot smarter than most of the average cameras out there. This is a business that is deployed in every state in Australia other than Tasmania and Victoria. They have deployments in the US and the UK. This year they're going to do about $60 million in revenue. So very, very strong commercially proven technology. Most importantly for Acusensus is they just won a contract which is valued at $92 million over 5 years for all of New Zealand in terms of speed and seatbelt and phone compliance. So this is a business that's kind of going great guns in terms of its technology and contract wins. It's a pretty new business at the exchange. It's got, I think, still a really modest cap at like just over $140 million, I think it is. Extremely well funded. They've got $25 to $30 million in cash. So it just, for me, just ticks so many boxes. Even if you want to throw an AI angle in there as well, it's got that. And again, this is another business that's not cyclical. Like, governments are not, coming backwards on road safety. So there is a lot to like in this business, I think.
Mm-hmm. Now, I note that its share price over the past year has done very well, but year to date, not so much. Do you know why that is?
Yeah, there's been a few issues with Acusensus. It was widely reported that they were looking to win 2 big contracts, one in America and one in the Netherlands, the year before last. They fell over in both those, so the market got, I suppose, really disappointed in that. Since then, they've renewed contracts in New South Wales, they've renewed contracts in Queensland, they've got new contracts in WA, they've won this big contract in New Zealand. So I think the market's kind of got a little bit more excited about it, albeit I think from that New Zealand contract went from 90 cents to maybe $1.30, and it's come back to about $1 at the moment. All these businesses are pretty, I guess, driven by news flow. And if you have like a lack of news flow for a couple of months, people get a little bit bored. But I think long term, it's really hard to see how this business is not going to be worth a lot more money in 2 or 3 years than it is today. There's every chance that it's going to be a takeover target as well from a large technology company. So with all small caps, you're going to be accepting some sort of volatility risk in terms of the share price. But this is not a business that's not burning cash. It's continuing to see uplifts in its earnings and revenues and contracts. So I just think it's well worth a look.
Credit Clears, CCR, is the next on the list. How is this a recession-proof stock? I think, good times, bad times, cyclical economic cycles, are sort of a push and pull for this company, aren't they?
A little bit. Like, I like Credit Clear. Yeah. Just to sort of walk back, Credit Clear is what I like to call a soft touch debt collection business that's kind of very technology driven. So I think the days of this hard, like, kind of rock up in your door with like a nasty legal letter, a guy with a baseball bat asking for you to pay off your Telstra bill, those days are over. They're all kind of technology based. It's about you send someone a text message, you send them an email, there's an automated phone call. Things like Credit Clear use WhatsApp as well. And they operate inside really big tier 1 businesses. So I look at their client list, like Allianz Insurance, IAG, Suncorp, Council of Geelong, Vodafone, Vocus, TPG. These are really, really big companies with big books of debtors that people don't always pay. So Credit Clear sitting there with some really advanced technology, working out the softest touch to pay way, the softest ways to, I guess, approach debtors in order to pay off their debts. And they get really, really strong promoter scores. So if you look at I suppose, economy where, cost of living crisis is nothing new, one, I suppose, manifestation of that is going to be people are probably not paying their bills as quickly. So I think for big businesses to get a Credit Clear to come onto their books and help them managing their arrears is a really strong, I guess, investment thesis.
So Alcidion Acusensus, Credit Clear, 3 recession-proof portfolio stocks for Cyan Investment Management. Hey, Dean, just a final question. Do you tolerate poor performers? How long do you tolerate poor performers? Are you ever afraid to just cut your losses and run?
No, look, not at all. I think one of the aspects of, I think private investors is you get really emotionally attached to stocks, and you'll go, look, I'll hang on to it. I'll wait till I get back to what I paid for it. For us, if a company isn't performing like we expect, it's just an easy decision to cut and run. And it sort of makes financial sense. Like if you can realise a capital loss on investment and you're not emotionally attached to it, you can do it really kind of, emotionally removed. It's a positive thing to do. You don't want to be concentrating, spending your time on, I'm just hoping the stock will get better, even though I can't see any potential silver lining at the moment. So yeah, for us, it's just an easy decision. Cut and move on.